Hello everyone, hope you all are doing well. Welcome to Diplomat's Desk. I am your host Meet Shah. Today we need to talk about something that touches everything from the price of your next foreign holiday to your EMIs to the way India deals with the world's largest economy. The Indian rupee has slipped to a new all-time low against the US dollar around 19.6 to 90.7 rupee per dollar, with different markets reporting trades between 19.56 and 90.74 during early trade on 15 December 2025. This is not just a number on currency screen, it's a signal about our trade, geopolitics, and our investors' confidence and our economic choices. So let's unpack why this is happening, what it really means, and how the India US relationship is right at the center of it. First, the basic facts. Over the last 2 weeks, the rupee has been setting one record low after another. On December 2nd and 4th, it breached the 19 rupee per dollar mark for the first time in history, hitting around 19.28 to 19.42 at the peak. The currency had already fallen sharply through 2025 and is now down about 5.5 to 6% year to date, making it Asia's worst performing currency this year. Today is December 15. It slid again in early trade to fresh low around 90.6 plus before the Reserve Bank of India, the RBI, stepped in to smooth the move. At the same time, foreign investors have been pulling money out of Indian markets. Reuters estimates foreign investors have sold over $18 billion in Indian stocks in 2025 and about $2 billion just in December so far. Bond markets as are like stressed. The 10-year agreements of the government bond yields has spiked to around 6.6% as foreign investors lighten their bond holdings too. And crucially, India US trade talks are stuck. High US tariffs on Indian goods, including those tied to India's discount purchase of Russian oil, are weighing on exports and sentiments. A meaningful deal is not expected before around March, according to the multiple reports. So, the rupee is falling, investors are nervous, and the India United States economic relationship is in delicate but decisive phase. Before we go any deeper, a quick and simple frame. Think of the rupee like any other price. It's the price of the Indian money in terms of dollars. That price is driven by the four big forces. First, trade flows. Are we importing more than our exports? If we need more dollars to pay for imports than we earn from exports, there is a constant demand for dollars. Capital flow. Are global investors bringing money into India, buying our stocks and bonds, or pulling money out? Relative interest rates. Are returns in India attractive compared to the US? If the US rates are high or Indian rates are seen as a capped, money tends to move towards the United States. Sentiment and risk. If investors are nervous about trade tensions, geopolitics, or policy uncertainty, they demand a risk premium, which usually means a weaker currency. The RBI can step in with Forex reserves, selling dollars and buying rupees to slow the fall, but it cannot permanently fight all four forces at once. Right now, four forces are pushing against the rupee. Key driver first, India US trade tensions and the stalled deal. Let's start with the diplomacy. Over the past year, US tariffs on Indian goods, especially those linked indirectly to the India's continued purchase of discounted Russian oil, have become a major friction point. To respond, India has tried to diversify export markets, quietly negotiated for tariff relief, and used diplomatic channels to keep broader strategic ties with the US on track, including Defense and Technology Corporation. On December 10th and 12th, 2025, senior delegations from both countries met in New Delhi for crucial trade talks, hoping to reach at least a mini deal that rolls back some tariffs and set a path to a broader pact. The outcome, no final deal yet, some positive statement about good progress and a possible framework by March 2026. But market heard something different, more waiting, more uncertainty. From an economist's point of view, trade tension hits the rupee in three ways. First, lower export prospects. If tariffs stay high or new ones are threatened, India's export growth to the United States, our biggest single export market, comes under pressure. That means fewer dollar earned. Second, lower investors' confidence. Global investors like predictability. When trade rules are unclear, they worry about profits and they respond by holding back new investments or even pulling money out. Three, policy constraints. India has to walk a fine line, defend its strategic autonomy, for example, on Russian oil, maintain a domestic political support, and keep economic ties with the US strong. That limits how aggressively either side can move, which can extend uncertainty, exactly what markets hate. So diplomatically, we are in what you could call a constructive limbo. Talks are ongoing, statements are positive, but concrete relief, especially on tariffs, is still some months away, and the rupee is paying the price in the meantime. Key driver second is foreign investors are heading for the exit. Second, big force capital flows. Foreign portfolio investors (FPIs) hold large stakes in Indian stocks and bonds. When they sell, they receive rupee from the sale, and they convert those rupee into dollars to take the money out. This creates extra demand for dollars and pushes the rupee down. According to the recent data, FPIs have sold over $18 billion of Indian equities in 2025 and around $2 billion just in December so far, plus additional selling in bonds. Why are they selling? First, trade tensions and policy risk. As we discussed, the unclear outcome of the US-India trade talks spooks global funds. Second, better risk adjusted returns elsewhere. With US yields now relatively attractive and some other Asian markets stabilizing, India risk return profile does not look as exceptional as before. Valuations, Indian equity indices like Nifty 50 and Sensex, which touched record highs earlier, we seen as expensive now, particularly in sectors where foreign investors are heavily concentrated, such as financials. The result is a feedback loop. Rupee weakens, investors worry more, they sell more, rupee weakens further. The RBI steps in to prevent a panic or a free fall, but it is clearly allowing the exchange rate to move weaker, focusing on smoothness, not a fixed level. Key driver 3 is trade deficit, oil, and the current account. Next, let's talk about the real economy, what we buy and sell with the world. India has a structured trade deficit. We import more than we export, especially crude oil and energy, electronics and capital goods, gold and other commodities. Even with the discounted Russian oil, the overall import bill in dollars is very large. When the rupee weakens, the rupee cost of this import rises, which feeds into inflation, particularly fuel and logistic cost, and widens the current account deficits in if exports don't keep pace. Now add tariff on certain Indian exports to the United States and sluggish global demand in some sectors, and you get slower export growth right when you need it the most. So at the trade level, high import needs plus weaker export plus tense trade relations equals to persistent demand for dollars equals to downward pressure on the rupee. Key driver fourth, RBI interest rates and reserves. Now, the role of Reserve Bank of India. Over the past year, RBI has cut rates modestly after an earlier tightening cycle to support growth, while the US Federal Reserve has kept rate relatively high for longer, even if markets now expect cuts in 2026. This has narrowed the interest rate differential between India and the US, making Indian assets slightly less attractive for carry trade investors who borrow in low yield currencies and invest in higher yield ones. RBI has been intervening in the forex market, selling dollars, buying rupees, but mostly to control volatility, not to defend a specific level like 90 or 88. We can see this in the forex reserves data. India's reserves have fallen from peak of around $703 billion in September to about $687 billion now, a drop of about 16 billion as RBI smooths the rupee's decline. Diplomatically and strategically, that's a conscious choice. India wants to signal stability, not panic. At the same time, it wants to preserve reserves for a true crisis, not to spend tens of billions just to keep the rupee at say 89 or instead of 90. For bond markets, RBI has also bought around 500 rupee billion in government's bond, helping cap yields after foreign selling pushed them higher. So the message from the Mint Street is we will lean against disorderly moves, but we won't fight gravity. Right now, gravity is pointing downwards for the rupee. Key driver 5, global backdrop. Why is the rupee weak even as the dollar softens? Here's the paradox. The US dollar index, which measures the dollar against a basket of major currencies, has actually eased recently as market anticipate US rate cut in 2026. So naturally, you may ask, if the global dollar is weaker, why is the rupee still record lows? The answer is local problems are overpowering global relief. For some other currencies, a weaker dollar has brought modest appreciations. For India, however, portfolio outflows, trade tensions, and domestic uncertainties have made rupee an outlier. In fact, Asia's worst performer this year. In other words, this is not just a strong dollar story, it's a weak rupee relative to peers story. Who is affected and how? Let's make this concrete. Ordinary household. Imported goods from like smartphones to certain medicines and electronics can get more expensive over time. Fuel prices may come under pressure if global oil does not fall enough to offset the weaker rupee. Over the next few months, this can nudge inflation up, making life a bit harder for the average family, especially in transport and energy. Second, student and tourist abroad. If you are planning to study in the United States or travel abroad, your cost in rupee just went up. Tuition, rent, and everyday expenses denominated in the dollars or euros all become more expensive when converted from rupees. Exporters. In theory, a weaker rupee helps exporters because they earn dollars but pay many costs in rupees. But if the weakness is driven by the trade tensions and tariffs, exporters may not see big volume gains, they just get some currency cushion against weaker order books. Corporates with dollar debt. Companies that have borrowed in dollars, for example, through external commercial borrowing, see their repayment burden rise in rupee terms. If they have not hedged properly, this can pressure their balance sheet. Now, government and RBI, a weaker rupee can inflate the rupee value of oil imports and defense purchases, potentially affecting the fiscal deficit. The RBI must juggle three things at once: inflation control, financial stability, and growth supports, all while preserving enough reserves for genuine emergency. Now let's put on a diplomat's hat. The rupee's fall is not just an economic event, it's a signal in diplomatic relationship with the United States. From India's perspective, the message is we need predictable, fair access to your market. Tariffs that punish us for legitimate energy security choices like buying Russian oil at a discount have real costs for our currency, our inflation, and our growth. India will likely push for tariff rollbacks or caps, long-term certainty on digital trade services and data, and recognition of India as a key partner in supply chain diversification away from China. From the US perspective, Washington wants assurance on Russian oils and sanction compliances, better market access for US companies in sectors like agriculture, digital, and manufacturing, and alignment on broader geopolitical priorities in the Indo Pacific. So the diplomatic bargain looks something like this. We lower tariffs and give you more stable access to our market. You give us a clear alignment on strategic issues and more openness to our firms. The rupee's weakness raises the stakes. A credible time-bound trade deal that eases tariffs and signals stability could help stem portfolio outflows and support the rupee. A prolonged stalemate, on the other hand, risks cementing the perception that India faces a structurally tough external environment, keeping the rupee under pressure even if the dollar weakens globally. Now, if you are a business leader, investor, or just curious citizens, here are the key signposts to monitor. First, announcements from Indian US trade talks. Do we see concrete timelines or just more vague positive discussions? Any specific news on tariff rollbacks, especially on sectors like steel, aluminium, or goods linked to Russian oil? Second, foreign portfolio flows. Are FPIs still net sellers or do we see stabilization or inflows? Daily and weekly data tells you if the sentiment is turning. RBI's tone and actions. Watch the next policy statement and any unscheduled communications. If they sound more worried about external stability and less focused on the growth, that's a signal. Also, track Forex reserves. A sharp drawdown would mean RBI is fighting more aggressively. Inflation and growth data. If the weaker rupee pushes up inflation, RBI's room to cut rates further shrinks. If the growth data softens too, the bank is caught between supporting growth and defending the currency, a classic emerging market dilemma. Now, global dollar and Fed expectations. If the Fed surprises with the slower rate cuts, the dollar could strengthen again, adding more pressure on the rupee. Conversely, a clear easing path could give India some breathing space if domestic issues are handled well. So, is this a crisis? It's important to be realistic but not alarmist. This is a serious but not a yet full-blown currency crisis. Reason for calmness. India still has a very large forex reserves close to $687 billion. The banking system is far stronger than a decade ago with better capital and lower NPAs. growth while facing headwinds is still expected to be amongst the fastest in major economies. Reason for caution is the rupee has become an outlier in Asia, weakening more than most of the peers. Foreign investors' patience can be finite. If outflows accelerate further, pressures can multiply. Prolonged trade tensions with the United States can lock in a weaker external position, complicating India's long term ambitions of becoming a manufacturing and export hub. So, this is best described as a warning light on dashboard, not an engine failure, but it cannot be ignored. Let me wrap up with the three simple takeaways. First, the rupees fall around 90.6 per dollars approximately is not a random shock. It's the combined result of stalled India US trade negotiations and high tariffs, persistent foreign investor outflows, a wide trade deficit, and heavy import needs, and an RBI that is managing, not resisting a gradual weakening. Second, the impact will be felt unevenly. Household and overseas students pay more, exporters get some relief but face uncertain demand, corporates pay with dollar debt feel squeezed, and policymakers juggle inflation's growth and diplomacy all at once. Third, the diplomacy matters as much as economics. A credible, forward-looking trade agreement with the US would not magically restore the rupee to 80, but it could stabilize expectations, slow capital outflows, and anchor India's long-term external positions. The rupee's journey today is telling us something important. Economics and diplomacy are now inseparable. The value of our currency is not just about interest rates and deficits, it's also about trust, predictability, and partnerships. If India and the US can convert their strategic convergence into economic clarity, the rupee may still be weak today, but the story in the long run can be much stronger. Thank you for watching this and for staying with this deeper dive. See you in the next one.